You open your banking app late at night just to check the number one more time. Your checking account shows a few $1,000s sitting there, untouched, doing nothing visible at all. Somewhere in the back of your mind, a quiet voice tells you this money is wasted, that it should be invested, growing, working harder than it currently is. You have heard this advice everywhere, from finance influencers to spreadsheets that calculate exactly how much you are losing to inflation every single month. But here's something almost nobody explains clearly. That idle cash sitting in your account might be the most powerful financial asset you currently own, not because of what it earns, but because of what it lets you do. By the end of this video, you will understand why cash is not a wasted resource, but a hidden form of leverage that changes every decision you make. And once you see this clearly, you will never look at an empty bank balance the same way again. This pattern shows up everywhere, in emergencies, in opportunities, in moments when speed matters more than yield. If this pattern keeps showing up in different parts of your financial life, the real question becomes what is actually driving it. There's a name for what cash actually provides, and it's called financial optionality. Financial optionality means having the ability to act immediately, without needing permission, without needing to sell anything, without needing to wait. This mechanism works because every other asset you own requires a process before it becomes usable money. Stocks require selling and settlement, often taking 2 or 3 full business days. Real estate requires months of listing, negotiation, and closing before a single dollar becomes accessible. Retirement accounts often carry penalties, taxes, or restrictions that punish you for needing the money early. Cash skips every single one of these steps completely. This mechanism operates across at least 4 layers simultaneously, and understanding all 4 changes everything. The psychological layer reduces anxiety because research from financial well-being studies consistently links cash reserves to lower reported stress levels. The behavioral layer changes your decisions because people holding adequate cash reserves make calmer, more rational choices during downturns. The economic layer creates leverage because cash allows you to buy assets when others are forced to sell at a discount. The environmental layer reflects your surroundings because access to liquidity often determines who survives unexpected disruptions and who does not. This single mechanism touches your spending, since cash buffers prevent panic decisions during tight months. It touches your saving, since saving without purpose often gets misallocated into accounts you cannot quickly access. It touches your investing, since the best opportunities almost always require immediate capital, not capital trapped somewhere else. It touches your debt, since cash reserves prevent you from borrowing at high interest during emergencies. It touches your retirement, since retirees without liquid cash often sell investments at exactly the wrong moment. It touches your income, since even high earners without cash reserves remain financially fragile. If this mechanism is real, then the common advice to invest every available dollar becomes incomplete. And once you see how this mechanism shapes your results, the next question becomes what you can actually do about it. The first stage requires changing how you perceive cash entirely before you change anything else. Principle: the zero buffer mistake. Most financial mistakes are not investment mistakes, they're timing mistakes caused by having zero buffer available. The principle works because emergencies do not announce themselves in advance, and decisions made under pressure are consistently worse than decisions made calmly. Studies on financial decision-making show that people under acute financial stress make choices that cost them an average of 20% more over a 12-month period. If you ignore this principle, every unexpected expense becomes a crisis instead of a minor inconvenience. This brings us to a deeper blind spot most people never examine. Principle: the invisible opportunity cost. You lose money not only by holding too much cash, but by holding too little cash at the wrong moment. This works because the biggest investment returns often come from buying during fear, when assets trade at 30 to 50% discounts compared to recent highs. Without available cash, you watch these moments pass by completely powerless. Historical market downturns repeatedly show that investors with available capital during crashes outperform those who were fully invested by significant margins over the following 5 years. If you ignore this blind spot, you remain a spectator during the exact moments wealth gets built. Now, once you understand that timing matters this much, the next layer becomes obvious.
Principle: the hidden cost of forced selling. Without cash, every emergency forces you to sell something, often at the worst possible time. This works because markets and life emergencies are not correlated, meaning your investments frequently lose value at the same time your personal expenses spike. Data on forced asset sales shows that emergency liquidations average 15% below fair market value compared to planned voluntary sales. If you ignore this cost, your portfolio gets quietly damaged every few years without you noticing the pattern. But this only solves part of the problem, because seeing the issue is different from controlling it. The second stage shifts from awareness into daily behavioral discipline around how cash gets used. Principle: the 3 to 6 month rule. Your cash reserve should cover 3 to 6 months of essential expenses, depending on your income stability. This works because shorter windows leave you exposed, while longer windows waste growth potential unnecessarily. Financial planning data suggests that households with at least 4 months of expenses saved report significantly lower financial anxiety scores. If you ignore this rule, you either remain dangerously exposed or overly conservative with idle money. This brings us to the daily habit that protects this buffer consistently. Principle: the untouchable account habit. Your emergency cash needs physical separation from your everyday spending account, without exception. This works because proximity creates temptation, and even disciplined people spend money sitting visibly in checking accounts. Behavioral finance research shows that separated savings accounts reduce unplanned withdrawals by roughly 40% compared to combined accounts. If you ignore this habit, your buffer slowly disappears through small, justified purchases over time. Now, once this separation exists, the next decision involves where exactly that money lives. Micro-CTA. If this insight is already changing how you look at money, take a moment to subscribe, because the next part is where this becomes practical. Principle: the high-yield placement rule. Idle cash should still earn something, even while remaining fully liquid and accessible. High-yield savings accounts currently offer 4 to 5% annually, with zero risk and same-day access. Choosing the wrong account costs you hundreds of dollars in lost interest every single year for no real benefit. If you ignore this rule, you pay an invisible tax simply for choosing convenience over a 5-minute setup. But this only solves part of the problem, because manual habits eventually break down under daily life. The second stage removes willpower from the equation entirely through systems that run without you. Principle: the automatic transfer system. Set an automatic transfer of 10 to 15% of every paycheck directly into your cash reserve account. This works because automation removes the daily decision of whether to save, eliminating the moment where willpower typically fails. Automated savers consistently accumulate larger reserves within 12 months compared to manual savers attempting the same goal. If you ignore this system, your buffer grows inconsistently, shrinking during tight months and rarely recovering fully. This brings us to the moment your buffer eventually reaches its target size. Principle: the overflow investment trigger. Once your cash buffer reaches its target, set a rule that automatically redirects extra savings into investment accounts. This works because cash beyond your safety threshold loses long-term growth potential, costing you compounding returns over decades. A single year of excess idle cash above your target can cost you thousands of dollars in missed growth over a 20-year horizon. If you ignore this trigger, your money stagnates exactly when it should be working harder elsewhere. Now, once these systems run automatically, your relationship with money begins shifting at a deeper level. The fourth stage changes the philosophy underneath every financial decision you make going forward. Principle: cash as a tool, not a trophy. Cash is not something to maximize endlessly. It is a tool sized precisely for the freedom it provides.
This works because the goal was never accumulation for its own sake, but the ability to act decisively when life demands it. People who view cash as functional rather than emotional report 25% higher satisfaction with their overall financial plan. If you ignore this shift, you either hoard cash out of fear or abandon it out of impatience. This brings us to the final, deepest realization underlying everything discussed so far. Principle: liquidity equals time freedom. Every dollar of accessible cash buys you time, and time is the resource you can never get back. This works because options compound just like money does, opening doors that pure investment growth alone cannot open quickly enough. People with strong liquidity report making career and life changes within 6 months, faster than those without available reserves. If you ignore this truth, you remain trapped in decisions purely because moving feels too risky financially. And once these small actions begin stacking together, the bigger picture finally becomes clear. This week, you track every dollar currently sitting in checking, savings, and any other accessible account. You identify exactly how many months of essential expenses that total currently covers for your specific situation. This month, you eliminate one unnecessary recurring expense and redirect that exact amount into a separate account. You replace your current low-interest savings account with a high-yield option offering 4 to 5% returns. This quarter, you automate a transfer of 10 to 15% from every paycheck into your dedicated reserve account. You build a clear overflow rule that redirects extra cash into investments once your target number is reached. This year, you define the exact dollar amount that represents true financial safety for your specific life situation. You commit to reviewing and adjusting that target number every 12 months as your expenses change. And once these small actions begin stacking together, the bigger picture finally becomes clear. You are back at your banking app, staring at that same balance from the very beginning of this conversation. Except now, that number means something completely different than it did before. That cash is no longer wasted money sitting idle. It is quiet, available power waiting for the right moment. You now understand why optionality matters more than maximum returns during certain seasons of life. There are 2 cycles operating here, and you are already living inside one of them today. In the virtuous cycle, you act wisely by building a clear reserve sized for your actual needs. You see progress as that buffer grows steadily through automated, consistent contributions. You gain confidence because emergencies stop feeling like catastrophes and start feeling manageable. You make better decisions because fear no longer drives your financial choices during hard moments. Results accelerate because you have capital ready exactly when the best opportunities appear. In the destructive cycle, you ignore the signal and keep every available dollar invested or spent. You repeat the mistake of being forced to sell assets during the worst possible timing. You lose options because every emergency becomes a crisis requiring high-interest borrowing. You feel stuck because decisions get made from fear rather than genuine choice. Results deteriorate because compounding setbacks slowly erode years of previous financial progress. You are already inside one of these cycles. Which cycle are you feeding today? Research on financial resilience consistently shows that households with adequate liquidity recover from setbacks within months, while those without often take years to fully stabilize. This is not really about cash at all. It is about preserving your ability to choose freely. Money, at its core, was never meant to be a trophy. It was always meant to be a tool. If you found value in this conversation, subscribe for more practical financial insights that help you build lasting freedom. The future of your money is ultimately decided by the habits you repeat when nobody is watching.